Welcome to another Yieldstreet webinar. Be sure to visit www.yieldstreet.com to learn more about our offerings and to sign up to receive the latest updates on our webinars and on our market. Or you can download the Yieldstreet mobile app in Google Play or the App Store. If you're an originator, we'd love to hear from you. Be sure to click through on the Raise Capital page on our website or reach out to our originators at originations@yieldstreet.com. We'll have some time at the end of our presentation to answer some questions, and we would appreciate it if you would submit those questions through the Q&A box at the bottom of your screen. Very briefly, I am Barbara Anderson. I'm the head of underwriting for Yieldstreet Private Business Credit, and I'm here today with Larry Curran, the managing director of Yieldstreet Private Business Credit. We've been together as a team now for the past 12 years. My background is in commercial banking. I spent almost 20 years as a senior underwriter and manager at major money center banks. I manage portfolios of specialty finance company loans as well as retail manufacturing and distribution loans. Larry, on the other hand, was a serial entrepreneur. He started many companies of his own and successfully exited those. He's also an angel investor to many entrepreneurs. And we are now here together at Yieldstreet Private Business Credit. So we come at the transactions that we look at from two different viewpoints. We're truly two sides of the same coin. Today, I wanted to go over our agenda for this afternoon. We're going to discuss a little bit about private business credit and what our mandate here is at Yieldstreet. We want to talk a little bit about what makes us different from specialty finance. And then we want to discuss some of our recent transactions that we've completed here at Yieldstreet so far. And then last but not least, we'll open it up to some questions. And again, please submit those through the Q&A box at the bottom of your screen. So Larry, why don't we get started? Tell the folks a little bit about what makes private business credit different than some of the other asset classes here at Yieldstreet.
Great. Well, thank you for the introduction, Barbara. And for all of our listeners, we want to make sure that you realize as we get towards the latter half of the opportunity discussion today, we're going to be talking about actual deals that are live, some of the kind of workshops we're working on right now for some stuff that will be coming out in the near future. And our goal is to help educate you on the process, the way we think, how I think about the global business impact of what we look at, and how Barbara looks at it from a tactical structure and compliance, and making sure that we have everything buttoned up tight for our legal and compliance departments. And what we want to talk about today is when we met with Yieldstreet, Barbara and I had already had a prior company, and our goal was always to work with emerging businesses that were growing. Despite what was going on in the marketplace, finding companies that continue to grow, have a business model, have infrastructure, managers, and despite everything that's going on today, are still growing. The problem is that the disruption in the capital market has made it more difficult, and it always does. I got my start during the savings and loan crisis in 1989 and 1990, and at that point, bad debt sales was just an emerging market into the private marketplace, the FDIC, et cetera. Then the Great Recession of 2007, we founded a company called Vian Receivable Investments, where we were poised to take advantage of the dislocation of capital assets and liquidity. And here what we're doing is we're taking advantage of the opportunity for the need with the desire and need for cash flow from our investors. So at a time when fixed income is really spotty at best in the marketplace and people are looking to augment their incomes and retirement incomes, et cetera, finding fixed income investments is as challenging as ever. And what our goal was to find businesses that are growing with good technology and have an ability to grow with us on the platform. So for example, we'll be talking about one of our newest partners, Raystone Capital. their business that's been growing for the past year, and their growing opportunities create a growing opportunity for us. And we'll talk about those details, but despite what's going on in the marketplace, this is a group that started lending to our supply chain finance group over a year ago, and it was just a couple of $1 million. Today, that facility is approaching $100 million and still growing, and those are the types of business that we look for. So what's different here at our class in the businesses that we look at is that we're not looking to just do a bridge loan or a one-off and one done with a company. What I do is I look at how does our capital help this business over a longer period of time, not a 1-year term note or a 2-year term note and done, but over the next 3 to 5 years, does our capital, our structure, and the need of our investors yield in that company provide the business the runway that it needs to continue to grow? So ideally, i.e. with Raystone, the first deal we did was just about $25 million. Our goal is to consistently do $25 million over and over again, and then work with other clients within their book that will grow over and over again. So when you as an investor come onto our site, you'll say, oh, it's a Raystone Capital deal. They specialize in this, and this is kind of the yield spectrum that you look at so that you can become comfortable and work with our businesses. And as long as our clients are happy with our business performance, our clients' portfolios are going to grow and our business are going to grow. And that's very different than the rest of the term notes that we do here on site with our real estate, art, marine, and our litigation finance verticals. So we're very excited to be here today to kind of tell you a little bit about how we look at that and share with you some of the companies that we are going to be looking at to bring out in the very near future on the site. And we'll also give you some background on some of the stuff that's currently available on the site here a little later on in the discussion. So Barbara, the infinite question of all, what is the difference between private business credit and specialty finance? It's almost the gating question we get from everybody, from our internal stakeholders to our external. So if you could tell our audience, what does that mean?
Absolutely. A very frequently asked question. Specialty finance companies are non-bank lenders that typically fund individual consumers and individual small and medium-sized businesses. Here at Private Business Credit, we don't actually lend directly to consumers and small businesses, but we can provide the much needed capital to those specialty finance companies who do. So by way of example, a specialty finance company might originate a $100,000 small ticket equipment lease for a local business. Now, while we can't fund that transaction directly, we could fund a portfolio of 100 of those transactions for $10 million, by way of example. So one of the things that I wanted to do today is actually walk you through how we fund specialty finance companies. In today's market, many companies are tapped out with their existing lenders, whether it's a bank, a fund, a family office, and they still have good borrowers that are in need of capital on the consumer side to, buy cars, to fund elective medical treatments like laser eye surgery, to furnish their homes, or to do home improvements. On the business side, small businesses are growing. They're looking to acquire new equipment. They're looking to grow their customer base, fill more orders, and they need that working capital to grow. So there are still good opportunities out there, but the specialty finance companies needs the capital to lend to them because their existing lines are full. So let me describe to you a transaction model that we've been using here at Private Business Credit to help those companies with their growth needs. Let's assume there's a consumer finance company that has 4,500 active loans totaling $45 million in outstandings. And they're looking for $15 million to grow their business and put out new loans based on the demand of their particular product. What we do is we will look at that entire portfolio and we will randomly select a pool of 15 million loans or 1,500 loans. We will then segregate that pool of assets into a special purpose vehicle just for that pool of loans. Now, before we do that, we make sure that we've truly selected a random sample, and we compare the demographics of our pool to the demographics of the whole pool in terms of the term of the loans, the interest rates on the loans, FICO score of the borrowers, state of origination, to make sure that we truly do have a representative sample. In addition to that, we make sure that the loans that we're acquiring in this special purpose vehicle are seasoned, at least 12 months on average. So we have a seasoned portfolio of randomly selected loans. And then there's one more criteria that we use at the outset. We remove any delinquent or defaulted loans from that pool. So we're starting with a clean slate. We're starting with a clean slate of seasoned loans segregated in an SPV that also has a dedicated account set up to control all of the collections. So the collections and the assets will be segregated into an SPV. We then participate in that pool of loans. The specialty finance company takes the funds that we provide against that pool and pays down their warehousing lines of credit, enabling them to relend under those facilities and grow their book of business. What's nice about this structure is that it's repeatable. It's repeatable across originators, and it's repeatable with specific originators, so that as our clients grow, their credit facilities can grow. Our structure requires that 100% of the cash flow generated from the collections of those assets be used to repay our debt. Now, we do pay a servicing fee to our originator, who continues to bill and collect those receivables on our behalf. But the balance of the principal and interest payments that are made each week or each month are transferred to us to repay our investment. So what we accomplish by doing that is we have a cash flow oriented repayment program. And there will be some equity still left in that portfolio after we're repaid our principal plus our target return. And those dollars would then go back to our originator. Now, why is that important? Why is it important for there to be, something at the end of the transaction paid back to our originator? Well, for two reasons. The first reason is that it provides proper alignment. It incentivizes the originator to work hard and do the right things to achieve that profit or equity at the back end of the transaction. And it also provides an additional cushion for our investors in the event that there is an increase in delinquency or losses. We have that cushion available to us to absorb that at the end of the transaction. So you will be seeing from us transactions in the consumer installments space as well as in the small business space that look a lot like this structure going forward. So, Larry.
Barbara, we've got a live question I'd like to pose for you. And I think it's very germane to what's going on in today's marketplace. And what the folks want to know is what types of assets and companies do we foresee being viable really over the next 3 to 6 months. I think we all probably agree with an election, a year end, and Lord knows what happens in flu season. How do we think about the types of assets that we focus on?
Yeah, so first and foremost, what is good about where we are right now is, I like to say we've been, pre-disaster. So we have a look at the impact of the first round of COVID so far. So one of the things that we look for are companies that were growing prior to the onset of COVID, companies that were able to remain open, and assets that have continued to pay through COVID. And we also sensitize our models for the potential of increased delinquencies if there were to be a second round of COVID. But what's important to us is that we focus on niches and focus on industries that are, somewhat less sensitive to the impact of COVID. And there are actually quite a few businesses and quite a few industries out there that haven't had, disastrous delinquencies and defaults as a result of COVID. And those are the assets that we're focusing on now.
The other thing I'd like to just add to that is we want borrowers that can help insulate us from the risk that we both agree is there. So the folks that are willing to work with us from a structure standpoint, can we remove all of the current delinquents? Can we have some measure of putbacks against future delinquents? What can they do to help us not absorb the unknown over the coming months? And the more willing an operator originator is to do that, the more like that we can get through it and get a closing done. So it's not, people want to say, are we just going to, do all this particular asset? And it's really about an operator, the management, where I come in is like, where's the business going, like, what's the exit strategy of the business? What's the big picture? And how can we help them get there versus just over the next 3 to 6 months? And what can they do to make sure that they can help us make the best informed and protected decision to make sure that we are making those growth strategies actualize. And that's really important to how we move forward on that. So as we talked about that, one of the areas that we are very active in is we're going to talk about is now what is supply chain financing. And before we kind of get into a definition of that, Barbara, I have another question here, and this is a question that keeps coming up, and I'd like to try and express this as best as possible to our investors, is we do get the question on, and we're going to be talking specifically about supply chain finance 1, which is live on the website, and Barbara's going to be talking about that. We'll be discussing it. People want to know, why don't we have the name of the company on there? And the reason for that is a couple of fold. Number one, they're a premium client to our originator, and it is a competitive environment out there, and everybody would love to have that client, number one, especially when you have almost $100 million outstanding to them. They want to protect their client, number one. Number two, that particular counterparty is a privately held business. It is a multi-billion-dollar privately held business that's well known with many industry brands, and they're private for a reason. And this is the type of requirement that we have actually from the counterparty, that we have to, we can work with them, but it's their request that they don't want to be known. They don't want their competitors to know what they're doing as far as supply chain finance. And so is at their request. So in a perfect world, I would love to tell everybody exactly what's going on. We're trying to do that as best as possible, meeting the needs of our originator and protecting their client, as well as protecting the client themselves from other people and industry information in a very tight marketplace. So I'm hoping that that's helpful in that. So Barbara, that might be a great segue away to talk about what is supply chain finance, because it is one of the areas that when things get rough, it's going to be growing.
Absolutely. Supply chain finance, Larry, as you said, is a growing industry. And the reason why it has grown so much in the recent past is, whether you're Ford or Amazon or Best Buy, you need a stable supply chain. And the suppliers, unfortunately, don't have the same access to capital that many of their larger buyers have. And that's why the buyers have gotten involved more and more with supply chain finance, because it has provided that level of stability of flow of goods into the supply chain. So let's talk a little bit about what supply chain finance is. The transaction that we have on our site, Supply Chain Financing 1, is actually a buyer-centric supply chain financing program. So what exactly is a buyer-centric supply chain financing program? Well, in this particular case, our buyer has put approved invoices on our originator's technology-enabled site. The approved invoices carry with them what we call an irrevocable payment undertaking. What that means is, for those specific invoices that the buyer has selected and transmitted to our originator, Raystone, they will pay a dollar amount certain on a date certain in the future, without discount, reduction, set off, or any other reduction in the amount that you typically see in buyer and seller invoicing throughout the industry. So we know what's going to get paid, and we know when it's going to get paid from the buyer. Raystone then goes to the suppliers that provided those invoices and offers to purchase their receivables at a discount. If the suppliers agree to sell their receivables at a discount, they are then funded immediately, and they have the benefit of payment on those invoices to use for the production of additional inventory to then, sell forward into the supply chain. So they get their cash immediately. What does the buyer get? The buyer generally gets extended payment terms. So we're normally talking about invoices that will be paid in the ordinary course by the buyer in 30, 60, or 90 days. Under the supply chain finance agreements, they have 180 days to pay those invoices. So they don't have to draw on their credit lines, for example, in order to make those payments. They have extended payment terms. So that's why it's in their interest to engage in the supply chain financing programs, in addition to providing that necessary working capital to their suppliers so that they could take on larger orders or more frequent orders. Keep in mind that the suppliers are often a lot smaller than the buyers, and they don't have the same access to capital that the buyer does. So this is actually helpful to them. And supply chain financing has been around for a long time, as Larry said, and it is growing. And we're hopeful to have more opportunities coming through Raystone and other originators that we can bring to you that will be diversified across many different industries, many different asset classes, and that provides, good returns based on the relative short-term risk that's offered in many of these supply chain financing transactions.
Got it. Thank you for that, Barbara. And we have some great questions. And these are right in line with what our ultimate goal is. Some of those are, is there going to be a program rolling forward where investors could look at a monthly opportunity to buy different credits in supply chain finance, which is, of course, near and dear to our heart. And of course, this is our first proof of concept for the platform. And for if any of you didn't see our detailed webinar, which is under the resources under supply chain finance 1 with the complete Q&A underneath there. I'm going to direct you there so that we don't spend all of our time there because a lot of the questions are answered there. But absolutely, as soon as we close this first deal, and so everybody understands, we close this deal on our balance sheet and it's closed, and we funded all of these suppliers. It was approximately 36 suppliers, roughly 500 invoices. We paid all of the suppliers current. And we now have the IPU from the main company, and that's due February 3rd of next year. So it's a very short-term obligation to be paid in full at that time. The next week, they asked if we wanted another 20 million. So immediately, they're ready and poised to grow within that particular lending opportunity where we can help support. And then the other place is that we are now in the fourth quarter. We have multiple new companies that will come online that we're going to start vetting in industries. And I'm sure that's the question that everybody's asking about, what industry and what happens if we go into a recession. So we want to think about industries that tend to fare better in a recession. And I would just encourage you guys to understand that Raystone is backed by the largest wealth manager in the world, number one. Number two, their CEO was previously the head of Citi Financials supply chain finance. We've got a team that has an impeccable track record. You can see in our presentation, they've lent on $500 billion with virtually zero losses. And that's why we pick these kind of partners and get into these kind of businesses that we can grow and give our customers confidence to move forward. So, so with that, Barbara, talk to me a little bit about some of the other types of things. We've talked about consumer installment. We've talked about supply chain. And the one thing I want to point out for everyone, the supply chain at max was 6 months. And our installment deals might be 24, 36, even 48 months. And then we're going to have things in between there. Some will be fully amortizing. The supply chain is a single payment at the end of the 6 months that you get your profit plus your intended profit and target profit with your principal back. In our consumer installments, you're going to be looking at amortized payments. So you might look at getting your principal back over the first 2.5 to 3 years. So we have a combination based on what your goals of an investor is. Do you want time, yield, principal back, interest only, etc.? And that's part of our goal, is to give you a diversity of those choices. And Barbara's going to now talk about a couple more that will provide those solutions.
Right. So another transaction that we've been working with is an originator of equipment financing transactions. They are both a lender and a lessor to commercial businesses that are acquiring large equipment. So, for example, the construction industry, the agricultural industry, transportation, lighting and film production are all specialties within this originator group. But one of the things that we like most about this originator group is that they are as experienced in the liquidation of these assets as they are in the origination of the loans and leases themselves. So I can tell you from personal experience that you learn a ton from the liquidation or the workout of a loan or lease. That is absolutely a great training ground for underwriting future loans. And these individuals have that level of experience that we really like. So in the case of the loan, for example, that particular transaction is an interest-only credit facility. We have an appraisal of the assets, and we're lending at a percentage of the forced liquidation value. The forced liquidation value means an immediate sale at auction. So the difference between the valuations that are provided by appraisers against equipment is really driven by time. Forced liquidation value being the lowest valuation for any piece of equipment because of that immediate sale and because of the fact that the equipment will be auctioned. In that particular transaction, just as some belts and suspenders in the underwriting, we actually had two different appraisal firms evaluate that equipment, and they came back with, very similar values. So we did a little bit of belt and suspenders there to make sure that we had the valuation right before we funded that transaction. In the case of the lease, we were financing new equipment. That appraised value came from an appraiser that was very experienced in the buying and selling of that particular asset class. There we used orderly liquidation value. In orderly liquidation value, we have a time frame of 90 days. So it's what would a willing buyer and a willing seller agree upon in a 90-day time frame. So that is the benchmark for orderly liquidation value. Now, again, we lend at a margin, so it's always a percentage of orderly liquidation value. And then ongoing throughout the life of the loan or the lease, we continue to do our homework. Our originator inspects the equipment on regular intervals to make sure that it's being maintained properly, that it's not being overused, so that if at the end of the loan or the lease we took possession of that equipment, it would be in the condition that we anticipated at the time that we did the appraisal during the underwriting. So we expect to see a lot more from this originator of equipment loans and leases. They have their own bank lines that they use to fund their portion of each transaction, but they are growing, and they're seeing their customers grow, and they're limited by their lenders to a loan limit. And we are coming in and helping them exceed those loan limits through our participation. So again, a recurring theme you'll see here, we're growing, our originators are growing, their customers and clients are growing, and those are the businesses that we want to focus on here at Private Business Credit.
Yes, we do. So when you see something on our site, folks, some of it is opaque because of our clients' protection, but what I want everybody to understand is that growing. We're there not because we're pulling irons out of the fire, because we're doing a distress. And and Barbara and I are both very schooled in the distress business. I came from the distress side, she came from the A+ side, and we kind of met in the middle. We know how to do that, but our key goal right now is to build businesses out of COVID that have a trajectory, have the right capital structure, and have a plan to come out of this process. And when we see companies like Raystone, for example, and what I can update everybody that's listening with today is that we are part of a much larger participation, and those participants have been in for much longer than we have, so their contracts are paying. Their IPUs are paying off every week, and we just got updated that everything continues to pay as agreed within our overall participation. Our due date is just forward. So those are the types of things that we want to let you know that we're monitoring on a regular basis to make sure we're on track. And then we can look at expanding that And as some of the folks asked, to look at, could there be programs coming out on a regular basis with these short-term notes, high-yielding opportunities? And that's exactly what we're trying to do differently than our other asset classes, is have these things that you can become comfortable with, whether it's Raystone, our new operators, our lease operators, so that you become comfortable with the underwriting and the processes. And even when things don't go right, how we get systemically out of that situation because we thought about it in advance. And that's really what we're looking for as we go forward. So we have a few minutes left. If there's any additional questions, please, while you have us on here, take advantage. And we'd like everybody to be able to hear the answers because we've had some very thoughtful inquiries so far. The last one that I'm seeing right now, Barbara, is in the event we have a second round of COVID, whatever, we go into a recession into the beginning of next year, how would that affect supply chain finance?
With respect to the particular supply chain finance transaction that we have on our site, it is in an industry that we believe is less susceptible to the impact of COVID. The industry was growing before COVID. It grew through COVID. And the forecast is for this particular niche of the industry to grow in the forecasted future, despite the fact that there might be a resurgence in COVID. One interesting thing that I'd like to point out is we did evaluate an apparel retail supply chain finance transaction a little while ago. And we turned it down, and we turned it down for two reasons. One, I didn't think that the return that was being offered reflected the risk that we were being asked to take. But also, I had some concern about how store-based retail on the apparel side was going to come through the holiday season. And I didn't think it was appropriate for our investors to take that risk right now. So, you know, if I wouldn't take that risk myself, I wouldn't ask our investors to take it either. So we were very cautious. We liked the first one because we didn't think it was, you know, as susceptible to the impacts of COVID as some others. And we've declined transactions because we didn't feel that the risk was appropriate to take right now.
Yeah, and and just so everybody knows, we typically have, you know, tens of millions, if not 100 million plus in our pipeline every month. And we're triaging and turn things down on a regular basis because we realize not only do we have to underwrite it and close it, which we have full capacity to do, but we have to make it make sense for you, both structurally, risk mitigant. Does it make the kind of yield that you're looking for and is in the tenor and the term that makes sense for what our investors are looking for? So thank you for that, Barbara. Again, for some of the new listeners that weren't on our last webinar, could you just quickly talk about the risk difference between factoring and supply chain finance?
Yeah, absolutely. So factoring and supply chain finance are really a yin and a yang, right? So we talked about the supply chain financing where, you know, Raystone goes to the suppliers and offers to buy their receivables. That sometimes is called reverse factoring because normally factors don't, you know, ring up suppliers and offer to buy their invoices. It's the other way around where suppliers go to factoring companies to sell their invoices at a discount. The other thing in traditional factoring that you see out there is when a supplier goes to a factoring company, the factor very often advances a percentage of the invoice. So let's say 80% of a particular invoice. Then when the invoice is paid, they get the balance less the factoring fee. Now, why is that? The factor is lending at a percentage because they're not really sure what discounts, allowances, you know, offsets the buyer might be taking. In our case, if you remember, I said we have an irrevocable payment undertaking where the buyer puts in writing exactly what they're going to pay. So it's different for a factoring company. There's a little bit of a guessing game going on there. So they advance less to the supplier to cover that eventuality that maybe 100% won't be paid. And the supplier has to wait to get paid on a portion of that invoice. That's why this particular transaction is a little bit more attractive to the suppliers, because it's a straight discount without that holdback per se. I hope that was helpful.
Yeah, I hope that was helpful, because the key is at the end of the day, your factor is interfacing on behalf of you with the risk of the buyer. Here we have the direct buyer is our, in other words, we're going directly to the buyer to get the payment. And the factor does the same, but the factor still is subject to damaged goods. It wasn't what we wanted. It's not a valid, they could dispute the validity of the invoice. Here, because the actual payer, the buyer at the end of the note, has approved 100% of everything, went through everything and said there's no opportunity for putbacks, chargebacks, etc., you get one payment from where you're ultimately looking to get it from factoring anyways, but there's none of those rights and offsets are there. So that's why most of your major Fortune 500s use supply chain, but they get it at a very, very low rate. Not what we're doing here, but that's what's giving us the ability to get a risk return reward for our investors, is that this is at a 10% annualized rate. We now have roughly 4-ish months, a little bit over 4 months left. So it's a very, time light opportunity to come in. And we recently also reduced the minimum investment for $5,000 for our new investors that want to try out what we're doing here at Private Business Credit. We wanted to make it more simple to get on the Yieldstreet platform and become, really a co-pilot for these businesses, because we can't grow them without you. They can't grow without us, and together we can get it done. And that's really what our big vision is here at Yieldstreet, is create this global platform that people can participate directly in these commercial assets, and we can all grow together and really kind of help our industries and our businesses out of this, kind of worst time that we've seen in our lifetime. And despite that, there's some good news out there, and we want to take advantage of that, and we want to bring that to you in our offerings that you'll see in the upcoming weeks and months. So, Barbara, if you have any closing thoughts, the last question, as we have about a minute left here, seasonality. In what we're doing in our particular supply chain, would we expect Thanksgiving and Christmas to be an uptick to volume in the industry that we're in?
No. In the particular industry that we're in, we're not expecting an impact from seasonality. Now, in the transaction that I discussed earlier that we chose not to do, that's obviously a highly seasonal business. So for us on our supply chain finance transaction, no, not a lot of seasonality there. It's a stable industry throughout the year.
In other words, we're not waiting on Black Friday to make it happen.
Not waiting on Black Friday for something magic to happen. That's right.
Which is exactly why we didn't do the apparel stuff, gang, and why we stuck to kind of our knitting of what we're doing. Lastly, I have another question that just says, just maybe reiterating, what are the yield targets that we have for our investors, and the different types of tenors that you will have kind of related to an investment yield?
Yeah, I mean, the interesting thing about our business opportunities is they really range the gamut. So, you'll have a supply chain finance transaction that might be 4, 5, or 6 months and might have a target interest rate of 10% annualized, give or take. And then we might have, transactions that are 24 to 36 months, particularly on the consumer installment side. But in those transactions, we're getting immediate repayments of principal and interest. So the good news there is we're putting money out a little longer, but we're getting money back right away. So the month after we make the investment, we're getting money, we're getting principal and interest paid back. So we have those transactions, and then we have a few interest-only transactions, like on the equipment side that I discussed a little bit, where, you know, those are medium-term facilities, 18 to 36 months, and they pay interest only, or they pay, you know, fully amortized straight line payments each month. So it's really a diverse group of assets, and we like it that way. We like to have a lot of different options for our investors to consider, and they all provide, you know, a little bit different risk return issues as well. So, you know, as low as maybe 8% and as high as perhaps 12%, somewhere in that range. In the COVID world, I think we're being a little bit more conservative for a little bit less of a target return. I think, you know, it's not necessarily a bad idea to trade credit quality for rate, or to put in those extra structuring guardrails in a particular transaction now to block and tackle some of the risk associated with COVID. So we've been trying to do a little bit of that too.
Great. So thanks everybody for being here today. Again, yieldstreet.com. You can get our app and download it from the App Store. We have new offerings coming up in all of our asset classes, almost on a bi-weekly, couple times a week. So please stay tuned to what's coming up. If you didn't get a chance to see our webinar with the details of the current supply chain finance, again, that is in the resource tab under that offering. To date, we've already distributed over $20 million of that transaction, and I think something around 12 or 15% is still available. It is at a 10% annualized yield. Of course, there's only 4 months left, so you can impute what that means to you as an investor. And all we can say is we look forward to the next time. We're going to continue to try and educate and bring you up to date on the things we have cooking up in the kitchen. And we'll look forward to seeing you next time on Yieldstreet.
Absolutely. Thanks for joining us this afternoon.